Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Alex Glukovsky, co-inventor of ZKsync and co-founder and CEO of Matter Labs. ZKsync is an advanced Ethereum Layer 2 blockchain network offering privacy and scalability using ZK proofs. In this conversation, Alex and I discuss the benefits of ZK technology for financial use cases, architectural considerations in building blockchain networks for complex industries like finance, optimal infrastructure for tokenized financial assets and workflows, ZKsync's trustless network and shared liquidity vision, and more. Thank you very much for joining us today. Please welcome Alex Glukovsky. Alex Glukovsky, welcome to Rebank.
Hello, everyone. Thanks for having me.
It's wonderful to connect with you. Huge fan of everything that you are working on at Matter Labs. Maybe to kick off, if you want to give us the high level, how do you describe what you're building at Matter Labs in a few paragraphs?
Absolutely. At Matter Labs, we are the creators of ZKsync, which is a scaling solution for public blockchains for Ethereum that is using zero-knowledge proofs for scalability and ensuring integrity of the computations and transactions that we're scaling on the blockchains. So what ZKsync started as was a research project. It was one of the very first ZK rollups on Ethereum. Then it quickly evolved over time as the developments in zero-knowledge proof cryptography were improving and the production-grade quality of software improved. We were able to build the very first ZK VM, the ZK rollup that supported Ethereum Solidity smart contracts without modifications that you could deploy on the ZK rollup for the very first time. And since then, it evolved further, and what I would call the third generation of the ZKsync protocol is known as the Elastic Network. It transformed from being a single rollup into a network of blockchains that are connected and secured by zero-knowledge proofs. And this is something I'm extremely excited about. Like for me, this is the architecture that can bring us closest to the vision of blockchains that we've been dreaming for many years since the inception of Bitcoin and Ethereum. This mission of blockchains of bringing the world of value on the Web3 and like basically moving all things that touch value on blockchains and building this internet of value where different protocols, users, institutions, companies are connected in a very similar way how the internet works today, where you can talk from anyone to anyone else. You can transact, exchange value, do programmable stuff, and all of that without relying on trust in specific individuals or specific authorities. Building this peer-to-peer network where everyone can verify it. Like in the ultimate vision, you can verify it on your mobile phone. You can have everyone in the world be part of this network connected together. And every single person, like 1 billion people, 10 billion people can verify all of this activity on their cell phones. That's roughly in which direction the ZKsync is evolving right now.
Amazing. All right. So I think there are a few really interesting points which we can dig into. One, which I'm sure is just kind of household subject matter to you at this point, and questions that you're probably tired of fielding at this point, but related specifically to zero knowledge technology and specifically how that's different from many of the other public and private blockchain solutions that are out there. And I guess specifically in the context of finance, why you view that as uniquely powerful. And then separately, I think it'll be great to get into the architecture that you just laid out, the sort of elastic network, and how that maps toward what you view as the sort of ultimate end state of these types of networks. So maybe to start, would you mind defining zero knowledge and explaining why it's relevant to what you do?
Sure. Zero knowledge proofs or ZK proofs are a family of cryptographic protocols that can attest to the integrity of computation. So we can guarantee certain computational facts without necessarily revealing the underlying or all of the underlying information. It might or might not be relevant. Like you can use it to ensure privacy, but you can also you can use it just for scalability without any privacy properties. That's why I prefer to call it ZK proofs in short, that encompasses all of this. The why zero knowledge proofs or the ZK proofs are so valuable in the context of blockchains. The superpower of blockchains is that these are the networks with computational integrity that can ensure that every participant, all of the participants of these networks, cannot be evil. This is this fundamental transition from the world of trusted authorities that are supposed to not be evil, that claim that their motto is don't be evil, to the world where they simply cannot be evil. They cannot violate the rules. The rules are set before, the rules of the game are equal for everyone. They are set before the game. When you enter it, you committed to these rules, you know that no one can violate. This is incredibly powerful. Trust is a $1 trillion industry. If you look at a lot of professions in the developed world, roughly 15% of all people employed in the US, for example, are in some form of trust building functions, whether it's in the legal or sales or relationship building and so on, because trust is really important. And once you can replace trust with automation, you can save a lot of money and you can save a lot of accidents and problems that arise from the breach of trust, which occurs occasionally. So now the way it works with blockchains, the first generation of blockchains, such as Bitcoin and Ethereum, is that every participant of the network has to follow the don't trust, verify maximum. Everyone is supposed, like if you read the Bitcoin white paper from Satoshi himself, everyone is expected to run a full node of Bitcoin and re-execute and re-verify every single transaction from every single participant. Ethereum is taking this one step further, enabling reach Turing complete computations, enabling smart contracts and much more flexible programmability of things that you can do on the blockchain. But it fundamentally does not alter this assumption. Everyone is still supposed to run a full node and everyone is still supposed to re-execute all of the computations on Ethereum. This is why Ethereum is designed in such a way as to enable running a full node on lightweight consumer hardware. And a lot of constraints of scalability that we have is derived from this fact. It's very, very important. It's fundamentally important. Now, the limitation is obvious. If you have to run it on consumer hardware or even on some very, very lightweight device like Raspberry Pi, you cannot have all of the world's financial state and all of the world's value transactions be run on this blockchain. That's just physically impossible. You cannot keep all of this state in your memory or on your hard storage, and you don't have enough bandwidth and you don't have enough computational power on this simple device with all the complexity of billions of people will be transacting. And this is why we have a proliferation of scaling technologies that make some compromise either on security or on decentralization or on trust assumptions. So if you cannot re-execute every single transaction, then this means you either don't verify it and you just trust someone else, or you ask someone to verify it on your behalf and you start introducing some complex game theoretical incentives for those people not to cheat, and then it all goes out of hand. You end up reinventing the traditional world of finance, reintroducing trusted authorities and institutions that guarantee that certain blockchain is now scalable, but yet trustworthy, and the risks are low, and there are some teams watching over it. Simply because you cannot do it any other way, or you could not until the zero-knowledge proofs emerged and became production ready and became mature enough that you could actually use them in production. So the way you can apply ZK proofs to scale blockchains is for every chain, for every block of this chain, all the transactions that are packed into this block are executed, and the proof of this execution is provided through zero-knowledge proofs. And this proof actually acts as a compressing of computation. So you take all of these transactions, you produce a single short piece of data that can be verified on every mobile phone in under 1 second, that guarantees that all of the transactions were applied and the end result is so and so. And it's mathematically correct and it's impossible to cheat, like mathematically impossible. And it's all open source. The method is open source. The code that produces these proofs is open source. Anyone can verify it. Anyone can audit or review the audits by public security professionals, and they can be sure that this is the correct result. And then the magic happens, because we can now take the proofs for many different chains and we can produce a proof that verifies this many different proofs. And we can apply this operation over and over recursively, combining more and more proofs together until we get one single proof. Maybe we put it on some big settlement layer like Ethereum, and then we produce the proof of execution of Ethereum itself. And then this can be this final proof, contains all of the proofs for all of the computations for all the transactions in the world. And this basically gives us the ability to make all the participants, all of these chains and all the individual user participants perfectly honest. None of them can be evil. And so now we can properties of the system emerging because not only the users don't need to trust each other, machines can perfectly trust each other, so they can exchange messages, and we can build some very complex systems with interoperability, with building in privacy, building all sorts of things that were not possible in a world where everyone has to have full visibility of all data and re-verify all the transactions.
Got it. That makes a lot of sense. A few points I'd love to dig into there. One, it's probably worth maybe just a brief description of the benefits in your mind of the ZK approach versus an optimistic rollup type approach, which I think is more currently pervasive in the market, the likes of Arbitrum, Optimism, and others.
I would say it's only pervasive because the optimistic rollups were a bit earlier. And the reason they were earlier, to be honest, is because it was easier to cut some corners. And we know that most of them enabled the fraud proofs not so long time ago. So essentially they were operated as proof of authority systems for a number of years. But for whatever reason, they had their first mover advantage and they had some user base. The people who are using optimistic rollups today did not have all the functionality and all the cost benefits on zero knowledge proofs or ZK rollups. And this is now changing. But the fundamental difference is, one, you get much better security guarantees. ZK rollups are essentially inheriting security in full from Ethereum, unlike optimistic rollups, which introduce some trust assumptions. What's really interesting is if we are building the Internet of Value, just like the Internet as we know it cannot run on a single server, this new Internet of Value cannot run on a single chain. And I think it's kind of widely accepted truth by now. There will be many chains for various reasons. For technological reasons, because of scalability limitations that are inherent to different chains, but also because of political and business reasons and different motivations that people have to launch their own chain and the desire to have control and customizability, because you cannot build a solution that perfectly matches all the use cases. We can talk about specific properties that people can configure, why it cannot run on a single chain, but the reality is we'll have many chains. And if we'll have many chains, then the most fundamental problem that comes to the foreground is how do we connect them? The interoperability becomes the number one question. With optimistic rollups and also with any type of cryptoeconomically secured systems, not with cryptographically, but cryptoeconomically secured systems where you have people and incentives, it's really hard to build trustless connectivity where systems, machines can trust each other. So you have to rely on introducing new trust assumptions with external bridging solutions, or you have to introduce some very rigid rules, how you structure the chains and basically force every chain into giving up their sovereignty or part of their sovereignty and just becoming a part of global conglomerate, basically a monolithic system that is sharded but not really independent. With ZK proofs, if you to connect ZK rollups and validiums, you don't need to go any of this route. You can build native protocols for interoperability that will be fully trustless. It will not rely on individual, on honesty of individual participants or validators or bridge operators. They cannot be hacked. There's no way to manipulate, There's no way for them to be evil. So even if the operators are evil or compromised, it will not affect the security of the system. And yet enable every single chain to be fully customizable and sovereign and independent or autonomous. They can make their own choices without having to adhere to the same standards. So the rough analogy is if you're building an office that is supposed to have multiple offices for different companies, with the world of optimistic rollups, all you can build is a huge open space where you have different desks, but it's one big space. You have to be like everyone else. If you want to switch the lights up and down, if you want to open the windows or close it, you have to coordinate with the entire space and you have to do what everyone else is doing. There is no privacy. You can see what everyone else has on their desks. If it's loud in the building, then it's loud for everyone and so on. What we can do with zero knowledge proofs is individual offices that have closed doors that you can shut. You can decide what's happening inside your office. You can control your space. You can control the environment fully. And yet you have access to the common spaces and you can go to any other office very quickly. So that's the biggest difference today in terms of the product properties that you get from the systems.
Got it. So on the subject of privacy, We hear the word privacy often applied to ZK systems, and it seems like one of the leading value propositions. Can you just talk about, even at a basic level, what you mean by privacy in this context, and maybe some examples of the types of privacy that are possible in a ZK environment that aren't in other environments?
Sure. So the blockchains had very hard time with privacy since the inception for a very long time, for the reasons which we discussed before. If you have to re-verify every single transaction, you need to know what every single transaction is. All of this data has to be kept public. If you hide the part of this data, how do you ensure that what you don't see is being executed correctly, that there is no manipulation happening there? Like, you either have to trust someone, and then it's not a blockchain system, it's just some custodial trusted bank or institution, or I don't know what to call it, or you need some means to ensure integrity of this computation. And basically, we don't have anything else. We only have two technologies that can do this. One is ZK proofs, and the other one is TEs and trusted execution environment. The latter is hard to use as a primary protection because it's hard to guarantee that there are no flaws and no bugs. And historically, there have been many bugs in this trusted execution environments. And you also have to trust the vendors, Intel or AMD, to guarantee to keep things securely. And everyone suspects that there are backdoors. And so this cannot really be used in the context of high stakes. You can use it as a second factor protection, but you cannot use it as a primary factor. Now, ZK proofs is something that uniquely enables this. You can mathematically guarantee that whatever is happening in this system is correctly following the rules, but you don't have to disclose the full data. You can disclose parts of this data. You can expose some properties. You can show proof of reserves. You can show individual accounts to individual participants, and they're all of their balances, what's happening on their accounts, but you don't have to show everything publicly. There are two ways how you can construct such a privacy system. The one way is privacy at account level. This is what we've seen with private blockchains like Zcash, or private privacy such as Tornado Cash. Those are systems optimized just for one use case, only to ensure privacy for transfers, and they work.
Meaning, just to be clear, so the rest of the blockchain viewers would not be able to see who took part in a transaction and or what was exchanged in the transaction?
Exactly. Even the fact of actually transferring something that touches multiple accounts, it's pretty mature technology, as we can see with Tornado Cash. It's been used by evil state actors in part, and it was heavily attacked by the governments around the world because it offers really good protection. It comes with its own compliance challenges. It comes with bad actors, but it's also a privacy preserving technology, and privacy is a basic human right. We cannot speak of mainstream adoption of blockchains if every single transaction is going to be transparent. That's nonsense. No one would trust it. No one would go and make purchases on the street with which would disclose the entire financial history of this person, whoever they transact with, right? It works really well for this one specific use case, only transfers or swaps, in a way that only the people who are participating in these transactions know about their transactions and their data. Now, it's a lot more challenging to inject smart contracts into this type of system. The smart contracts, as we know it from Ethereum, for example, written in Solidity, which is a Turing-complete smart contract language, which enables you to write basically arbitrary programs on this publicly shared state, they're not possible in the exact same form. Tornado Cash and Zcash just don't support smart contracts at all. There are a number of privacy-preserving systems being developed that introduce new languages for smart contracts, but you have to write them in a special way. They're not easy to write. They're conceptually very, very different and difficult to implement. So you cannot reuse existing protocols. You cannot reuse existing security best practices in those systems. They are emergent, and I think they are still a couple of years away. What you can do is build new chains that ensure privacy not at an account level, but at a chain level. So this probably be correctly described as confidential blockchains rather than fully private blockchains. You can think of a bank launching their own chain as an L2 on Ethereum that is connected to Ethereum, that is connected to other private chains, where the bank can see everything that's happening inside the blockchain, but it does not show it to the world. It still uses Ethereum and ZK proofs to guarantee the integrity of every single transaction, of the state of all smart contracts that are being executed there. You can have all the tooling from EVM available to developers and the users of the system. All the wallets work exactly the same way. The explorers work. Everything is kind of standard, except for the fact that the bank can manage the visibility of the data and can provide it to, you can see your balances. You can maybe see some shared public state, but you cannot see balances of everyone else. And no external observer can see the balances of the system. We would call it a private validium. And this is something that hits a very big niche demand today with financial institutions. The reason blockchain technology has not been broadly adopted by financial institutions so far is because on the one hand, they need to follow the compliance, security, and privacy requirements from regulators. So they want a system that they fully control and that is private. But on the other hand, the system is not valuable that much if it cannot talk to other systems. If you cannot use the publicly available assets from public blockchains, if you cannot connect to other private blockchains and do the exchanges. So what the institutions have attempted in the past were consortium chains, where multiple institutions, banks, or entities would come together and try to build something where they all agree on the system, they all run validators and try to interoperate there. But you run into many challenges. Like it's really, really hard for them to agree on this consortium to ensure compliance and also to ensure the kind of deal with the fact that there's still no privacy versus vis-a-vis those other chains, those other entities that run this chain, right? Because everything that's happening on the shared chain is still visible to all the participants. And that's difficult. With private Validium, we can solve that. And we see the huge wave of interest and progress being made. And I think this is what will actually bring the mass adoptions to institutions. And we see it very clearly now with a couple of pilots that ZKsync had with UBS and Deutsche Bank and some of American banks and institutions, where each of these institutions can have their own closed version of the system, which is fully private, fully compliant. They ensure control, they exercise control over what's happening there, who is let in, who is let out. It's part of the broader Ethereum ecosystem. It can host Ether, stable coins, real world assets issued on other chains, and they can talk to each other. Like two banks can interoperate and can have private transactions that are only visible to these two participants, not to anyone else, that kind of stay within the bounds of their two private systems. This is extremely interesting, and this is what Matter Labs focuses mostly right now, because there's a huge demand, and I think it's going to be what brings really the next wave of crypto adoption of institutions.
Got it. Quick terminology. So Validiums, tell me about that. That's the customizable sort of dedicated implementation of a ZK chain. Is that right?
That's correct. So we can call all of the systems ZK chains. A ZK chain is a blockchain that's secured by ZK proofs. And then the minor distinction between Validium and Rollup is, do you use Ethereum or some public blockchain, some layer 1 for data availability, or do you keep it internal, or you use something like third party for data availability? So third parties or internal, it would be called Validium. For layer 1 usage, it would be called a Rollup. Rollups are much better for crypto native users because they guarantee security, basically 100% inherited from the underlying layer 1. For Validiums, you have some trust assumptions around data availability. So whoever is handling data has to be trusted. But you still rely on layer 1 to verify the correctness, the validity of every single transaction. And this is why it's called Validium. So even if the operator is malicious or compromised or whatever happens, they can never execute an invalid transaction. That's massively beneficial, massively advantageous compared to just private chains.
Okay. All right. So maybe we could shift gears slightly, discuss the broader architecture that you envision. I think you made some comments early on about how ultimately the sort of initial vision of blockchain-based, internet or blockchain-based world could be delivered through, I guess, a ZK-based environment. And then maybe we can get into some of the specific use cases that you're working on with partners. So maybe as a way of getting into the broader architectural end state that you envision, ZKsync Era is, I think, your first production mainnet, like publicly available chain. And now it sounds like that has kind of evolved into what you referred to as the Elastic Network, and I think a series of kind of customizable, dedicated chains, which all can interoperate. Can you talk a little bit about that broader architecture?
Era is the first chain in the Elastic Network, which was followed by a number of others. We have a broad range of use cases or niches that have leading chains in those niches that have joined the Elastic Network. We have consumer chains such as Abstract, Sophone, Lens is launching a social network chain very soon. We have gaming-specific chains such as TreasureDAO, ZK Candy, and Exola, which is one of the largest gaming payment providers in the world, is launching the chain for billions of their active users. We have financial chains like Gravity. We have a really interesting category of chains launched or that are very close to exchanges, kind of following the Base model that Coinbase has with Base. We have Kronos, ZK Kronos chain that is working closely with Crypto.com. We have a chain from WonderFi, which is the largest Canadian exchange. We have a chain from Ripio, which is the largest exchange in LATAM. We have a Union chain, which is closely working with the largest exchanges in Southeast Asia, from Philippines, Indonesia, and Thailand, with, I think, close to 200 million KYC users that will have access to this thing. We have a couple of others. So this is very heterogeneous, very broad network of chains that reflects many use cases that we would not be able to do just on Era, because all those chains have some customizations, that they have some differences that they want to enforce with their tokenomics, with the way they handle MEV, and so on and so on. But they all connected together, and the interop that is coming this year will make sure that every user can connect to any application on the entire system, and the assets can move absolutely freely without friction and without any external capital requirements, without liquidity providers, natively minted and burned, which is secured by ZK proofs and Ethereum under the hood. So in this constellation, Era still plays an important role as a hub of this ecosystem. It can be the liquidity hub, like it's currently one of the largest chains by liquidity from the entire L2 space in Ethereum. And it's definitely a very large RWA hub with over 2 billion worth of real world assets tokenized on Era, which is second only to Ethereum itself, with 5 billion worth of assets, and all the other chains are way below. So Era plays this role of connecting these chains and serving as a launch pad for applications that can then launch their own app chains, and the liquidity and DeFi hub.
I see. So tell me more about the sort of interoperability between the various chains that you mentioned. I think I read in some of your materials that the various chains can nonetheless benefit from aggregated liquidity. Interested in understanding what that refers to. And then also you talked about the ability to seamlessly transact between different chains. Is that via a bridge? And if so, what's the design?
The connection between chains is baked into the architecture from the get-go. What makes the Elastic Network, like at the center of the Elastic Network, is the idea of the shared bridge. ZK proofs make sure that the chains cannot be evil. The chains cannot be evil can come together and have their asset hosted on a shared bridge. And this enables them to not just be able to exchange messages. Like you can send arbitrary message, you can make a method call from one chain to another, which the other chain will accept, and they will know that, okay, it's coming from this contract. I know it's the code of this contract. I know I can trust it because all of the security is provided by the same ZK proofs that I run on my chain. Every asset of the Elastic Network, whether natively minted on one of the chains or natively bridged from Ethereum into the shared bridge, can be transferred seamlessly across the entire network. This is currently not live yet. The implementation is on testnet, and it's coming live in a couple of months from now. But ultimately, you will be able to just do it like a method call and send attach value of arbitrary tokens to this method call between the chains. Why it's critical to have it as a native protocol, why you cannot use external bridges here. The way external bridges work is you basically have two types of bridges. The mint burn mechanism bridges only work with assets that are designed specifically for this bridge. This will work with USDC or USDT. This will work with OFT tokens by layer 0, but it will not work with native Ether because you don't have authority to mint and burn ETH. Only layer 1 has this authority. So that's why for assets that are bridged from other places, the only way for you to ensure interoperability is to invite liquidity providers, maintain reserves of this token on every single chain that participates, and manage these liquidity pools so that when someone wants to send ETH from chain A to chain B, these liquidity providers that have some reserves on chain B will send it to the user, and then they have to rebalance through sending this token through layer 1 or through doing some other things, or hope that someone will have to transact back from chain B to chain A, which will reset the balance, right? Which is not always the case. And it's of course really hard to manage for lower liquidity tokens. You can do it only for a handful of the top liquidity tokens. You cannot do it for the long tail. You cannot do it for NFTs. You are stuck with NFTs. NFTs don't support this type of interop at all. So because you have to maintain the pools of liquidity, those pools have capital costs because this capital is sitting idle and not doing anything. So you have to put these costs onto the users. And these bridges are charging the users with several basis points on every single transaction that is happening there. And you cannot maintain large amounts of liquidity on every single chain. So maybe for a few big ones, it works. But as we go down the long tail and some app chains, it becomes increasingly infeasible to have sufficient reserves everywhere. So there is no way for you to move this liquidity freely throughout the network unless you have the native interop baked into the protocol, which you can only do if you ensure the integrity of the chains participating. We can do it by ZK, keeping the autonomy and sovereignty of the chains. The optimistic rollups are forced to basically do it by requesting the chains to give up sovereignty, by limiting the number of chains that can participate in kind of this optimistic rollup clusters, which is not the case for ZK. We can support arbitrary domain. We can have hundreds, thousands of chains joining the system and still having access to this interop without incurring the costs on the underlines, without overloading the underline. And once you have this interop, once it's fully functional, the next step will be making sure that the user experience is completely seamless. That basically for the user perspective, you don't even have to think about bridging. You should be able to just connect to an application. You will see that it's on a different chain from the chain where you have your assets. You don't have to worry about this. You just say, okay, connect, transact, and then you do one confirmation, which will automatically under the hood bridge some assets to that chain, perform the operations, and bridge the results back to your chain. So ultimately, this uniform one-click experience is what's going to resemble the Web2 experience of just following the hyperlink with one click.
I see. So when you talk about shared liquidity, I imagine that's what you're referring to. The fact that you don't have this sort of fragmentation via the sort of second approach to bridging. All liquidity, all balances are in a sense available to transfer and interact with across chains in the network.
That's correct. Yes, we can speak about shared liquidity and shared users throughout the entire Elastic network.
Okay. Maybe just a clarifying question for me. So if I think about, the way that maybe, most sort of, multi-chain or cross-chain, tokens or assets work today, there's kind of a implementation on multiple chains, like the token contracts need to be deployed on multiple chains. But it sounds like what you're saying is there can be like a native instance of a token on one of the Elastic Network chains, and it can nonetheless transact on a different chain and be bridged back without a new deployment, like canonical contract deployment on all of the new chains.
Exactly. Technically, there are nuances, deployments on different chains, but you can have a standard contract that handles the bridging, irrespective of what token is coming from which chain. So this is something that is managed at the protocol level and basically is going to be pre-installed. We already have it for the tokens that are bridged through the native bridge, and it's going to be expanded to all the other tokens.
Okay, great. All right, so maybe we can then focus in on some tangible use cases. So some of the projects that you're working on today, you mentioned the range of different partners, the members of the Elastic Network who are running chains, but I think you also mentioned early on use cases with Deutsche Bank and UBS. Maybe that would be interesting to unpack, thinking about this context of finance and financial innovation. So Tell me about some of the use cases or projects that you're working on the finance side, and how the ZK approach or ZK offering is particularly relevant.
So this goes back to what I shared about the financial institutions. They are what we see with both Deutsche Bank and UBS. They are interested in building private chains that give access to their services to a much broader range of customers. And they can do things that would not be possible in a traditional financial world. So for UBS, they were offering tokenized gold, which is a product that they have internally for their customers. You can buy a fractional ownership of gold with physical delivery. And if they were to offer it to customers of other banks, this would require onboarding them as their own customers, doing a lot more work on compliance, but also performing settlement of transactions that would have to go through the traditional payment system, which has multi-day delays on settlement and introduces friction points, because you cannot just buy something and immediately confirm the ownership of this asset. You would have to wait until the funds arrive, and you have to do it completely separately, which basically means you would need to be onboarded as a customer to the bank, which comes with its own compliance burden and so on. In this system, what they were able to do is to offer these tokenized assets atomically swapped for a stable coin, which lowered the costs, increased the throughput, made it very easy to onboard all of these other customers. And this is what we see with other banks and other institutions, basically several components of the offering. They are tokenizing some of their own assets or services. They are using these chains as the custody for their clients, because they can ensure compliance, privacy, and security of these funds in a much better way than with external custody. And they interoperate with other financial institutions in a compliant and private and secure way.
Interesting. So when you talk about banks potentially being able to spin up their own customizable chains, I guess private chains, but which are nonetheless connected to the broader network, where they have visibility into all transaction information, but perhaps other market participants, either have zero visibility or visibility into only certain data points. And you think about replicating that across, many different banks. Firstly, in a sense, it's like a blockchain-based approach to core banking in a way, right? It's like the whole kind of transaction ledger and balance ledger of a bank. And then talk to me about how the sort of interplay, right? When like two banks then, or two financial institutions want to interact, how do they do that? They do that then in a sort of public environment, or there's like a privacy maintained connectivity between the two private chains. How does that work?
There are multiple ways to structure it, but let's take one example. You have two banks with their own private Validiums, and they want transfer assets or swap assets between each other. This could be either customers moving funds from one bank to another, or just banks doing interbank settlement, which currently they have to do legacy systems, sometimes through the correspondent banks, sometimes through some other means, which are very expensive and complicated. And they would be much better off if they were able to do it directly. They can now do it directly with stable coins. It could be either extrinsic stable coins, such as USDC, USDT. It could be stable coins issued by the banks themselves. The banks could just issue tokens that represent their own balances. And the other bank, if they have a good relationship, will accept the stable coins, because they have counterparty risk acceptance from this bank anyway. So the way it would work is, in this first scenario, let's say we want to make a swap. So Bank A would initiate a transaction into the chain of Bank B from the chain of Bank A that calls a swap method on a smart contract on the chain B. The bank would know what the smart contract is. They would agree ahead of time. They would review the code of the contract, and it would be something like, if you deposit this amount of this asset, you get corresponding amount of the other asset. And it's being sent back to the chain A. So the Bank A initiates the transaction. It happens on chain A. This then goes to chain B. Like basically they send the message off chain, which is being relayed by Bank B onto their chain. It's being executed, and then the preceding results are going back to chain A. And this can always be enforced through messages submitted through a priority queue on layer 1. Like layer one always serves as the enforcer of the rules. Like if the chain or the bank B would not relay some messages, you can always nudge and push it through Ethereum itself with censorship resistance guarantees that you get from Ethereum. So the transaction would basically have three parts. Like on chain A, you initiate it, you commit some funds, you burn them on chain A, creating a message with destination on chain B. On chain B, you redeem this, like you mint these assets. In the same transaction, you exchange them for some other assets, and then you burn this second asset with a destination back to chain A. And in the third transaction, you would then redeem this asset on chain A. And even though it's asynchronous and you have three distinct transactions, the whole operation is atomic. It's either going to execute and the swap happens at predefined conditions, at some price ratio, slippage, and whatnot, or it will not happen and it will be reverted, and whatever assets were sent from chain A to chain B will be sent just completely back. So that's one way to do it. The other way would be to create a third chain and interoperate through this third chain. But I think the direct interoperation is really interesting because that's something that's never been possible before. Because in the previous iterations, in previous attempts, you would have to trust the chain B. You would have to trust the operators, the validators of chain B to do everything correctly. And you might trust them as a person, but institutionally you have certain rules. You need to have guarantees that all of these rules will be enforced. Here, because both chains are deployed on the Elastic network, both of them are using the exact same ZK proofs for security and the exact same censorship resistant mechanisms on layer one, they can trust the other chain just the same way they trust themselves. Because it's the same code that is securing them. And they know that the operators can never be evil. They can never execute anything invalid.
I guess final thought that comes to mind as we wrap up, I kind of made this reference to traditional core banking systems. We're looking across the market now. We're seeing more banks exploring things like tokenized deposits. We're certainly seeing stable coins as either payment or settlement methods picking up. We're certainly starting to see them in sort of, real economy use cases, cross-border payments and various things. It would seem to me like a sort of integration point between some of these maybe private chains that you guys are working with banks to deploy into their core systems, where you can effectively easily transact across both kind of traditional banking assets and flows and fiat rails and on-chain flows at the same time as finance is in the process of upgrading its infrastructure could be really powerful. I wonder if you have any thoughts or insights based on the work you've done around how some of these chains can directly integrate or work together with existing core banking infrastructure.
What we see with our partners being done is relying heavily on this internal tokenization. So we see examples of banks where they have multiple subsidiaries in the country where they need to manage liquidity between the subsidiaries. And what they do is they tokenize their own reserves. And then they use smart contracts to control access and to kind of rebalance this liquidity across the entire banking system. This was kind of the top limit of what was possible until very recently, because the regulation was heavily anti-crypto and was like very, very limiting on what banks can and cannot do. I think 2 or 3 weeks ago, there was a directive from the US regulators, from White House, that the banks could start using crypto for custody of the crypto native assets, and the legislation of stable coins and interbank, all the financial regulations that are required to do it in a safe way is on the way. And I think it's going to be passed by summer or definitely later in this year. And everyone in the banking and financial industry understands this. And they're looking forward to do more than just internal systems. So I think the direct way to do it is tokenize your own assets, custody crypto native assets, and then use this in the architectural structure that we just discussed, where you just talk to your counterparts with their private chains, and also you use public infrastructure. You can go and use public DeFi protocols. You can use public crypto digital assets and offer it to your customers internally in your banking system with some internal protocols that regulate what happens to those assets enforced on chain. So yeah, there's this broad range of use cases that becomes possible through these mechanisms that we just outlined.
Excellent. Alex, thank you so much for your time. This was an incredibly insightful conversation. Really excited about what you guys are building and the impact that it's clear you're already starting to have.
Thank you, Will. Really happy to have shared this.
Alex Glukovsky, Thank you very much for joining us today. Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.